copyright of this video belongs to SIA Campus. Offenders will be prosecuted. When we look at non-residents, it is very important for us to understand how to treat interest. Now, we can basically go through this in a couple of very simple steps, which we'll do now. Right, so the first thing I want you to remember is, when you are looking at a non-resident, you should always first up consider whether or not the interest that they've received is from a South African source. Because remember, non-residents, if you look at their gross income definition, they only get taxed on income from a South African source. Now, remember, how do we know when it is from a South African source? We first always consider Section 9, and then if Section 9 is not applicable, we'll consider the common law. But interest is discussed in Section 9(2)(b), where it tells you that interest will be from a South African source if it is paid by a South African resident. So if a South African resident pays a non-resident the interest, it is from a South African source. Or if the funds were used in South Africa. Now, that will be, for example, let's say Mr. X is from Australia and he gives Mrs. Y, who is from the United States of America, a loan, and Mrs. Y uses that loan in South Africa. So she invested here or buys trading stock here and then starts selling in South Africa. Basically, if those funds, the loan, is what the interest will be paid on, it's used in South Africa, it's from a South African source. Then, if you've now decided that it is from a South African source, then you will add it to the gross income of that non-resident. Now guys, please remember, if it is not from a South African source, it basically, you'll have to stipulate that in an exam situation, but there are no South African tax implications then. If it is from a South African source, you will then apply Section 10(1)(h). Now Section 10(1)(h) tells you that if a non-resident receives South African interest, it is 100% exempt, unless that non-resident is a natural person who was physically present in South Africa for more than 183 days in the 12 months preceding the date in which the interest is received or accrued. So it's not in the last tax year necessarily, you count back 12 months from when the interest was received or accrued. Or if that debt relates to a permanent establishment in South Africa. Now, a permanent establishment is, for example, like a business, but this will be stipulated in an exam situation. Right, so then, if the person was in South Africa more than 183 days, or it relates to a permanent establishment, then it is not exempt in terms of Section 10(1)(h). If it is then not exempt, so if one of these two situations applies, then you will apply the normal Section 10(1)(i) interest exemption. This is the local interest exemption, which natural persons get, remember, and this is where the age of the taxpayer is important, whether or not the taxpayer is 65 or older. This is the same one that residents also get, but you must be a natural person. Then guys, that is then the normal tax side of it. Once you've done that, you have to then do the withholding tax on interest in terms of Section 50(b). Now, please remember guys, this must be a separate heading that we have to do it, a separate calculation. You cannot include it in your taxable income calculation. It's not gross income, it's a tax. Now, it is at 15%, but remember, there are exemptions for you. And the most important exemptions, so when these exemptions apply, there is no withholding tax. The exemptions are, if it's paid by the South African bank or by the South African government, Section 50(d)(a) tells us that. If the non-resident is a natural person who was physically present in South Africa for more than 183 days, or if it relates to a permanent establishment, then it will be exempt. In other words, guys, what does that mean? It means there's no withholding tax then. So if it's paid by the South African bank or by the South African government, or if the person was in South Africa more than 183 days in the preceding 12 months, or if it relates to a permanent establishment, then it's exempt from withholding tax, and if it's exempt, it means there's no withholding tax. Those are the most important ones there. And we'll now look at a little next example. Let's look at the following example. Michael is a resident of Australia. He was born in South Africa to residents of the Republic, but he immigrated to Australia 12 years ago when he turned 22. So guys, if you've immigrated, you are a non-resident. They also tell you clearly that this person is. So definitely, Michael is our non-resident. Michael's childhood friend Sheila lives in South Africa. She runs a small business. During a Skype call, Sheila told Michael that the business was experiencing cash flow problems. Michael felt sorry for his friend and offered to lend her money at a market-related rate. Sheila accepted. On the last day of the year of assessment, she paid Michael an amount of 50,000 rands in interest. Michael earned a further 20,000 rands in interest from a South African bank during the year of assessment, and he earned 10,000 rands correctly translated to South African rand from his Australian bank account during the year of assessment. So then there's a required that says A and B. A, assume Michael has not visited South Africa in the last 3 years. Calculate the tax implications for the year. And then B, assume he has been to South Africa for 200 days during the 12 months that preceded the day in which the interest accrued. Calculate the tax implications for the year of assessment. Alright, guys, so when we do this type of question, and we know there's going to be withholding taxes, because I want you to make sure that you see they talk about calculate the tax implications. So you need to know normal tax as well as withholding tax. Now, typically what I would recommend is that when you open up your script, you've got 2 pages. I recommend on the left-hand side, we do our withholding tax. And we do our normal tax on the right-hand side. The reason for this is just because withholding tax is usually a shorter calculation. You don't want to start on this page, run and stop there, and then normal tax on the left-hand page, run out of space, and then have to continue here. It makes it very messy. So just remember, guys, make it easy to mark and professional. All right, for all of these, I'm just going to do it on the one side, but we'll have headings, description, calculation, explanation. You might use a capital gains tax column, but there's nothing in this, but you might want to use that if that's the way you're approaching it, and rands. Now guys, please remember, nice and clear headings always, do it professionally. Alright, so here we go. So, when we are now looking at this, we are going to start with our steps. So the first thing we're going to ask ourselves is it from a South African source? So was it paid by South African resident, or were the funds used in South Africa? Now, if we look at Sheila, Sheila is a South African resident. She paid the 50,000, so it's definitely from a South African source. It was also used in South Africa. But the fact that she's already a resident, that's an easy one to identify. So we go to our normal tax section. Right, so interest, Sheila. This is an SA source because it's paid by a resident, 50,000 rands. Now, immediately, let's consider section 10(1)(h), because remember, we've now added the gross income step 2, consider section 10(1)(h). Now, it will be 100% exempt unless she wasn't the non-resident, which is Michael, was in South Africa for more than 183 days, or this permanent establishment. Now I know Sheila has a business, but this permanent establishment, it must be Michael's permanent establishment, right? And it's not. So, can you guys see? It will be 100% exempt in terms of section 10(1)(h). Now, whilst we are busy with this, let's move on. So I'm going to handle each interest on its own. If it's not exempt, then apply section 10(1)(i), so that's not applicable because it was exempt. Then do the withholding tax. Now guys, withholding tax is at 15%, but there is nothing if it's paid by South African bank or the South African government. This is not the case. Sheila paid it. If he was in South Africa more than 183 days, or if it's his permanent establishment, which is not the case. So, what can we see here under withholding tax? The interest from Sheila, 50,000 times our 15%, 7,500 rands. Right, like I said, guys, you obviously will have your own headings here. Alright, so that's the first one. Let's look at our next one. He then earned 20,000 rands from a South African bank. So, what will we do with that? Step 1, is it from a South African source? Yes. Why? Because again, it is paid by a resident of South Africa. Is it exempt in terms of section 10(1)(h)? Was this person in South Africa more than 183 days? Is there permanent establishment? No, none of those are applicable, so it's 100% exempt. Then we do our withholding tax on this again. Interest from an SA bank. Now, I'm just reminding you, there's an exemption if it was paid by a South African bank in terms of section 50DA. So, paid by SA bank, so it's exempt. And then the last one, 10,000 rands from an Australian bank account. So guys, when we go and look at our first step, is it from a South African source? Was it paid by a resident? No. Were the funds used in South Africa? No. So it's not gross income. So interest from Australia, not an SA source. Right, and that will be your effect on taxable income. Alright guys, so basically, as you can see, quite simple. So now let's look at our next situation. In our next situation we say, okay, now assume that he has been to South Africa for more than 183 days in the last 12 months. So we'll have our same break again. So guys, I'm not putting the headings down now just for the sake of time, in interest of time. Right, but let's go through it. So, is it from a South African source? Our first question again. So we start with Sheila, that 50,000 rands. Is it from a South African source? Yes, paid by a South African resident. So that doesn't change. Interest, Sheila, an SA source. Then, it tells us, is it from a South African source? Yes, included in gross income. Is it exempt in terms of section 10(1)(h)? Well, in this case, the person was in South Africa for more than 183 days. So that means it will not be exempt then. Right, so it will not be exempt in terms of section 10(1)(h). Not exempt as in South Africa more than 183 days. So not exempt. So already I want you to just see, look at the difference. In situation A, it was exempt. Now it is not exempt. Okay, so what do we do then? Then we have to consider section 10(1)(i). So section 10(1)(i), this is the normal interest exemption. They tell you in the question that 12 years ago he was 22, so he is now what? 34 years old now. So younger than 65. So this is limited to 23,800. Remember, you must always clearly state your limit. So 23,800 rands. Let's then do the withholding tax, guys. So interest that we received from Sheila. What did we see when we looked at our steps? It will be exempt if the person was in South Africa more than 183 days. So exempt in SA more than 183 days, so it's exempt. So guys, look at the difference there. Situation A, there was exempt withholding tax. So can you see how how this section works with each other a lot of the time? So if you look at the net effect, that was 0 and 7,500 rands over there. So you get taxed in one place. That's why it's considered the final tax. Here, there's a net amount 26,200, but there's no withholding tax, so you only get taxed here. Doesn't always work, as I'll show you in the next one, which is the interest from the bank of 20,000 rands. Now, look at the interest from the bank. So interest, bank, we know it's from a South African source because it was paid by a South African resident. 20,000 rands. Section 10(1)(h), It's not available as the person was in South Africa more than 183 days. And section 10(1)(I) would be available, but you only have 23,800, so we've used it all up. So fully used. Okay, now, guys, just remember, you'll see now what I meant is usually if you haven't used this up already, you would now apply that section 10(1)(I) here, and this would be fully exempt because that's less than 23,800. Okay, that's just what I wanted to point out to you. Just remember, you can only use it once. Then we've got the interest from the bank, the withholding tax. And what do we know about interest from the bank? It's exempt. Right, so it is still exempt. Situation A and B, still exempt. So in this case, as you can see, the person will still pay tax over here, right? So it looks like it works the same as in the first one, but my example, what I meant is if this, let's assume that this first tax, this 50,000, was not in this question at all, then you would have used this section 10(1)(I) interest exemption over here. Right, 23,800 would be available, but obviously it would be limited to 20. So the net effect would be null, so then you would have no tax here and no tax here. So this is just what I'm trying to say. There is a possibility that there won't be normal tax and also not withholding tax. It can happen. Watch out for a bank. Right, and then the last bit of this question, again, interest from Australia, guys. You just need to put it down. Interest, Australia, not South African source. And that is it. Non-residence and interest, a great place to score marks. Just follow a nice, steady thought process, guys. Go through the rules in the Act, and you can do it. Best of luck.